You're basically making a loan when you deposit money in a bank account. Good lenders want to be paid back primarily from the borrower's cash flow, relying on collateral, insurance, or secondary sources of payment. How can you assess your bank's financial health? Many bank customers asked this during the Great Recession. I was asked to talk with a few key customers during that time to give them guidance and comfort about our bank's health. It's something people don't think much about until there are headlines about bank failures. Every bank files a quarterly call report with their regulator. These reports contain key financial information about the bank. The regulators provide analysis of those reports. This table shows where you can get that analysis. These reports compare a bank's key ratios over time and against their peer group. You're looking for ratios that are deteriorating over time or are significantly worse than their peer group. A good page to start on is the Summary Ratios page. Here are some key items on the Summary Ratios page to monitor. Net income as a percent of average assets. Large losses eat into the bank's capital. Think of capital as the first layer of any source of losses before uninsured depositors and other creditors are at risk of loss. Net loss as a percent of average total loans and leases. This shows the loan losses as a bank has recently experienced. Allowance for credit losses on loans and leases to total loans and leases. The allowance for credit losses is the bank's best estimate of future loan losses. Losses in excess of their calculations will hit future net income. This ratio states the allowance as a percentage of loans. A low percentage compared to peers puts future income at higher risk. But it may also mean that the bank has a lower risk in their loan portfolio than their peers. Non-current loans and leases to gross loans and leases. Non-current loans are ones 90 days or more past due, plus loans that are so impaired that the bank isn't accruing income on them even if they aren't past due. That total is stated as a percentage of all loans. A high percentage means that their loan portfolio has quality issues that could lead to future losses. Net loans and leases to deposits. A high ratio means that the bank has invested a large portion of its deposits into loans. Loans are hard for a bank to liquidate if lots of deposits ask for their money at once. This can cause a bank failure. The leverage ratio, total capital ratio, and non-current loans and all other real estate owned divided by Tier 1 capital plus ACL. So these are three capital ratios. I won't bore you with the details on how to calculate these ratios, and you can get the calculations from the UBPR instructions on the regulator website if you want them. Banks fail when these ratios get very low. These ratios are a better indicator of an impending bank failure than any other ratio I discussed earlier. Bank regulators publish enforcement decisions and orders they make against banks or employees of banks. These orders may say a bank is not acting in a safe and sound manner, needs to improve its capital position, or has loan quality issues. The lists of regulatory ratios or enforcement actions may have seemed overwhelming to you. If so, you may want to follow a bank rating agency. Here are some options for you. IDC Financial Publishing provides ratings for banks and credit unions. This was the rating system I encountered the most in my banking career. Bauer Financial rates all banks and credit unions. You can get their ratings for free. Bankrate is a popular site where you can get free ratings. They tend to focus on consumers. Weiss Ratings and Veribank offer bank and credit union ratings. Larger banks are covered by credit rating agencies like Moody's, S&P, and Fitch. AM Best is known for its insurance company ratings, but it also ranks banks. You can also monitor debt and equity investment reports for investment information about banks. These reports are tailored to bond and equity investors, but have valuable information about the overall health of the bank. Many small banks aren't covered by investment analysis.